The tech sector is absorbing an unprecedented demand shock. Infrastructure spending is projected to consume up to 3.5% of total U.S. GDP. That translates to an $800 billion projection for tech capital expenditures by 2026. The market currently assumes a seamless conversion. Look at this second curve. The expectation is that this massive capital injection will translate directly into exponential compute power and compounding software revenue. But history provides a specific warning for this trend. When capital expenditures in a single sector double within a 3-year window, like the 1990s fiber optic buildout, it universally leads to a massive misallocation of funds. We are now seeing that same doubling occurring year after year. This spend is being artificially accelerated by government directives and subsidies. These non-market forces encourage companies to move aggressively, often blinding investors to traditional risk metrics. The market has priced in the perfect execution of an $800 billion spend. This ignores both the degrading economics of software and the strict physical limits of the hardware. While hardware spending is exploding, we are seeing a paradox at the model layer. Software capabilities are rapidly becoming a commodity. Right now, open-weight models developed in China are already achieving frontier-level capabilities that match the top-tier offerings from Western tech giants. Moonshot's Kimi K3 model is a primary disruptor. It delivers performance on par with OpenAI and Anthropic at a fraction of the cost. This severe price compression breaks the economic linkage justifying the hardware build-out. If intelligence is cheap, the infrastructure return vanishes. If frontier models become cheap commodities, the multi-billion-dollar data centers designed to rent out compute power risk becoming stranded assets. Software commoditization is already eroding margins. But a much harder, physical limit is about to destroy the hardware timeline itself. To see the real bottleneck, we have to look past software models and examine the hardware that actually powers AI, logic, and memory chips. Specifically, high-bandwidth memory, or HBM. This is the non-negotiable component required for AI GPUs to function. The production of HBM is entirely dependent on one specific choke point in the global supply chain: extreme ultraviolet, or EUV, lithography machines. ASML holds a total monopoly on these machines. Their production timeline dictates the speed of the entire global AI rollout. No amount of corporate capex or government spending can bypass the physical limits of these systems. You cannot print chips faster than the machines allow. The projected $800 billion in capex must literally pass through these specific EUV machines. It is a physical bottleneck that financial capital simply cannot solve. We can calculate the exact scale of this bottleneck using hard data from ASML's investor presentation. One EUV machine can process roughly 300,000 wafer starts per month for a single layer of a chip. The baseline capacity is 300,000 wafer starts. But advanced chips aren't printed in a single pass. They need 5 to 6 separate layers. Divide that baseline by 6, and actual output drops to just 50,000 completed wafers a month. This 80% degradation in output happens purely because of the complexity of the manufacturing process, before we even consider the type of chip being made. Technological complexity alone has slashed the foundational throughput of the AI supply chain. Now, apply the specific requirements of high-bandwidth memory to that 50,000 wafer capacity. Producing 1 gigabyte of HBM requires approximately 4 times the wafer footprint of standard DDR memory. Dividing by the 4 times HBM density requirement leaves an effective output of 12,500 units per machine. With ASML shipping around 65 EUV machines this year, half allocated to memory, the global cap on HBM production is severely restricted. Compare that mathematical limit to the massive facility expansions from manufacturers like Samsung and SK Hynix. They are building on a massive scale. This creates an empty factory problem. These companies are building massive cleanrooms, but they cannot buy enough EUV machines from ASML to fill them. ASML's own guidance shows they are only investigating a 30% capacity increase for 2028. They are actively choosing to avoid overcapacity. ASML is keeping supply tight to maintain their pricing power. Hardware supply cannot and will not scale to meet the AI bubble's euphoric demand. These physical constraints are now rippling back into the equity markets. Secondary AI hardware and infrastructure companies are currently trading at astronomical forward earnings multiples, exceeding 100 times today. A 100 times forward multiple mathematically requires a flawless, unconstrained physical rollout to be justified. But because hardware deliveries are stalled by EUV limits, hitting these earnings projections is a physical impossibility. This growth ceiling is appearing just as the Federal Reserve shifts its focus back to price stability under new leadership. The Fed is signaling a play-action pass, keeping policy tight now to earn the credibility to ease later. For a market trading at 100 times earnings, this combination of physical bottlenecks and restrictive policy removes the very liquidity that supports these high valuations. The market has mispriced the speed of the AI revolution by ignoring both the laws of physics and the shifting tides of monetary policy. The realization of this hardware bottleneck, combined with cooler inflation data, is triggering a violent quantitative factor rotation. We are seeing a mass exodus of capital occurring out of large-cap growth and tech momentum trades. That capital is flowing straight into small-cap value and yield-preservated assets. Historically defensive sectors like utilities and real estate are surging, even as long-term yields remain elevated. These unloved sectors are rallying because they offer safe yield and are completely immune to the ASML supply chain chokehold. The AI revolution is entering a phase where hyper-growth narratives have collided with physical reality. The current market cycle hit its physical limits, aggressively punishing those betting on infinite scale and rewarding those who understood real-world constraints.